Hello everyone, Steve Lentz here with Discover Options, and welcome to this edition of several reports for advanced options traders. This will be for Friday, September 29th, getting ready for Monday's open on October 2nd, 2017. Presented materials for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Today, we have three reports. First, the S&P 500 Condor Butterfly Timing Report that answers the question, is now a good time to initiate a Condor or Butterfly campaign? Okay, also we have the SPX Bull Put Spread Timing Report that answers the question, is now a good time to sell out of the money put premium about 30 days out, one standard deviation away? Is now a good time to do that? Finally, we have the SPX Directional Likelihood Report that answers the question, based upon past occurrences of our current market condition, what is the market likely to do? Go up, down, wobble around a bit. Okay, 5, 10, 15 days out. So let's get right to it. Before that, I want to make sure that you have access to this free ebook co-authored by myself and Jim Graham. Just click on the link, give us your information, we'll get that right out to you. Also, if you could please subscribe, hit the subscribe button. We'd love for you to get advance notice or quick notice of any new videos we come out with. Okay? All right, here is the current market condition. This is the S&P 500. You could see we analyze this from three different perspectives. Price action-wise, we had an inside day on Thursday. Friday was an upswing day with a higher high and higher close, higher low and higher high, excuse me. And this happened, inside bar followed by an upswing bar, while we are above the 50-day simple moving average, and our stochastic, our 15-3 stochastic, is in overbought territory and trending upward, between 60 and 100, trending above that 3-day simple moving average. It's the percent D we're talking about there. All that combines for a fairly unique market condition that's occurred roughly 70-some times since January of 2000 up till today. All right, so that's our current market condition. That's what we'll refer to quite often in these reports. First off, let's go to the Condor Butterfly Timing Report. Since January of 2000, we've had 4,481 daily closes of the S&P 500. Now, of those 4,481, 65.8%, okay, 65.8% of those bars were favorable for selling option premium, where the actual 21-bar movement was less than the SIBO skew-adjusted implied movement coming from the VIX. All right, so in other words, 65.8% of the time, the market did not move as much as what was being implied by the VIX, the skew-adjusted VIX. Okay, so keep that in mind. 65.8 is the benchmark. Now, during that time, our current market condition occurred 71 times. Okay, now of those 71 times, 71.8% of those bars were similarly favorable, where the market did not move as much as what was being implied. 71.8 is higher than the benchmark by about 6%, and that's what the selling edge is. We have an implied selling edge, option selling edge of 6%. So statistically, it's more likely than normal that the current market condition will end up being a favorable one for market-neutral option premium selling strategies. Okay, so that's for the Condor Butterfly Timing Report, and for those advanced traders that use those strategies. For those of you that like to play from the bullish side, maybe selling bull put spreads, maybe hedging those with an at-the-money bear put spread, that's a good strategy. Maybe you bend your condors to lean bullish a little bit through the use of various types of strategies. Here's the report for this. So, and we're presuming we're going out 30 days, a standard deviation away when we sell those puts. So as I mentioned before, since January 2000, we've had 4,481 daily closes of the SPX. Now, of those 4,481, 83% have been favorable bars for selling put premium, 30 days out, standard deviation away, where the actual 21-bar downside movement, 30 calendar days, 21 trading days, 21-bar downside movement was less than the SIBO skew adjusted implied downside movement. All right, 83. So you could basically sell put premium 30 days out, standard deviation away, every day, flip a coin, and 83% of the time, okay, it works out that that short strike would not have gotten hit, would not have gotten struck. It would have just expired worthless, and it would, never would. The market never did go down and hit that level. Okay, now, our current condition, as I mentioned, has occurred 71 times. Now, of those 71 times, 87.3% of those were similarly favorable for selling put options in that location and distance. Okay, so that implies an option premium selling edge, a put option selling edge of 4.3%. Okay, 87.3 minus 83. 83 is our benchmark. Okay. Of our current condition occurrences, 87.3 were favorable. So statistically, it's more likely than normal that Friday's bar will end up having been favorable, more than normal, have been favorable for selling premium out of the money, 30 days out, etc. Okay? So that's for the bull put spread timing report. It appears favorable. Now the likelihood report. This answers the question based upon the past occurrences of our current market condition. Where's the market likely to go? So what we do here is we use price distribution. Okay, we look at price distribution as a benchmark, and then we look at our current market condition and how price has been distributed of those 71 times in the past. And so what we do to determine price distribution is we use distribution bands. What we do is we take the close and we go a standard deviation up and a standard deviation down 5, 10, and 15 days out, and we just see if the market hits those levels or not. And so here's what we do. Here's a 5-day price distribution band. And so it's up here, and the question is the market going to go up and hit that 5-day band or not? Here's the one on the downside, the price distribution band. Will the market go down and hit it or not? Notice that the downside band is farther away from the close than the upside band, and that's because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. So that's why these bands are skewed a little bit. We do this not only for the 5-day distribution bands, but also the 10 and the 15. Now, let's look at the numbers. We go to the top here. And we can see that of the 4,481 occurrences, price hit the upper 5-day band 21.3% of the time, the upper 10, 15.8%, the upper 15, 14.8% of the time. The lower bands, the lower 5, 16.6, 16.8, 19.6. So these are the benchmark numbers. Okay, the historical distribution of price located right here. Now we go to those times when our current market condition occurred. In this case, it's looking at the last 72 occurrences. Okay, now of these 72 occurrences, price hit the upper 5-day band, 8.3% of the time, which is far less than the benchmark. You see that? That's why we have that negative 13 there. Let's look at the 10-day band on the upside, 9.7. That's again less. Upper 15, 11.1% time, less. The lower 5-day band was hit about the same. The 10 and the 15-day band hit less. So this is a picture of lower market volatility. Okay, that of these 72 occurrences, you could see that price struck 5 of these 6 bands less often, sometimes by a significant amount. Now, what we do also is we say, okay, on Monday, if price exceeds Friday's high, what's the distribution in that case? In this, for instance, this occurred 42 times where price exceeded the previous day's high after this occurrence, and you could see all 6 bands were struck less often. Again, a sign of lower market volatility. Now, if price exceeds the Friday's low, in that case you can see 5 of the 6 bands were struck less often. So clearly a picture of lower market volatility. I don't think we can really lean it bullish or bearish that much. Analyze the numbers for yourself. Hit pause. Examine it. Just eyeballing it here, I would not want to take a definitive, yeah, I'm not going to hang my head on it. I mean, some of these numbers on the upper band were, getting struck. Well, it's about a balance, I'd say. Even though you got these 2 blue numbers here, the others kind of make up for it. So I'm not going to take a bullish or bearish stand here. Just lower market volatility is the likelihood after looking at this report. Okay, folks, thanks so much. I'm Steve Lentz with Discover Options. Have a good week trading. We'll talk to you later. Bye-bye.